Right now, most people think the AI trade is done. Overpriced, overhyped, ready to crash. But Nvidia just posted data center revenue up 92%. In one quarter, that's $75 billion. That's not a bubble bursting. That's the floor getting wider. Today, we're ranking 10 AI stocks backed by real earnings, real growth, and real charts. And stock number 7 is the one nobody's talking about yet. Let's start with the obvious one, Nvidia. Full-year revenue hit $215 billion. That's up 65% from the year before. Data center alone made $62 billion in one quarter, up 75% year over year. CEO Jensen Huang called demand off the charts. Cloud GPUs are completely sold out. Here's the part most people miss. Nvidia isn't just selling chips anymore. Their new Vera CPU opens a new $200 billion opportunity. That's on top of existing GPU demand. Yes, the stock dipped after earnings in May. Classic, buy the rumor, sell the news. But fundamentally, nothing changed. Analyst consensus across 62 firms is still strong buy. For long-term holders, pullbacks like this have historically been entry points, not exits. Here's where it gets interesting. Broadcom just had its AI revenue grow 143% year over year, $10.8 billion in a single quarter. And yet the stock dropped 14% after earnings. Why? Because their next quarter guidance came in slightly below expectations, $16 billion instead of the hoped-for $17. That's it. That's the whole story. Meanwhile, CEO Hock Tan reaffirmed AI chip revenue guidance above $100 billion heading into 2027. Broadcom supplies custom AI chips to Google and Meta, plus the networking hardware that connects entire data centers. That's 2 revenue streams from the same AI boom. When the market punishes a company for slightly slower hypergrowth, that's often a gift, not a warning sign. But before we go further, here's what most beginners don't understand. The biggest names aren't always the safest bets. Sometimes the boring company is the smartest long-term play. That brings us to our next pick. Microsoft doesn't get the same hype as Nvidia, but that's exactly why it belongs on this list. Microsoft has woven AI into everything. Azure Cloud, Office, GitHub, LinkedIn, Copilot. Azure's AI services are growing faster than its core cloud business. And here's the key difference. Microsoft generates massive free cash flow. That cash funds its enormous AI bet, without putting the entire company at risk. If Nvidia is the shovel seller in a gold rush, Microsoft is the company that owns the land, the bank, and the general store. For beginners especially, this is the lower volatility way to get AI exposure, without betting everything on one chip cycle. Now here's a name that surprises people. Palantir posted 85% revenue growth in early 2026. US revenue crossed 100% growth for the first time ever. But the number that really matters is this one. Their Rule of 40 score hit 145%. That combines growth rate and profit margin into one score. Anything above 40 is considered elite. Palantir is at 145. They're also GAAP profitable now. Net income margin over 50%. Yes, the stock is expensive, trading at a premium valuation most value investors would avoid. But premium valuations often follow premium execution. And right now, demand for their AI platform is outstripping supply. If you're learning how to actually read these numbers yourself, hit subscribe now. We break down one sector like this every single week. Now let's talk about the underdogs. AMD makes data center AI chips that compete directly with Nvidia. Their accelerators are gaining ground with major cloud providers. AMD shares did drop sharply during the early June chip sell-off, down nearly 11% in one session. But that drop had nothing to do with AMD's actual business. It was sector-wide panic, triggered by Broadcom's guidance. Then there's Micron. Memory chips are in a genuine supply crunch right now. Smartphone makers are struggling to get enough memory because companies like Micron are redirecting supply toward AI data centers. Higher margins, higher demand. One report even noted Micron's stock climbing over 700% over the past year. That's the kind of move that creates real wealth. If you'd held through the volatility. Here's the surprising part most people skip past. The companies getting hit hardest in sell-offs are often the ones with the strongest underlying numbers. Panic creates the entry point. Fundamentals create the long-term return. Let's round out the list quickly. Oracle has transformed from boring database company to AI infrastructure player. Their cloud division is growing fast. Capital spending is expected to hit $50 billion this fiscal year. Alphabet remains one of the strongest core AI research names, alongside Microsoft, Nvidia, and Broadcom. Their Gemini models run on Nvidia's platform, while they also build their own custom chips. Then there's Astera Labs, smaller, less known, but described as next in line for AI infrastructure gains. They make connectivity chips that link AI processors together. Finally, Marvell, a higher risk, higher reward name, watched closely alongside Arista for AI networking exposure. Together, these 10 stocks cover the entire AI value chain: chips, cloud, software, infrastructure, and connectivity. Here's the bigger picture. Global AI spending is projected to surpass $2.5 trillion this year alone. Hyperscalers like Microsoft, Google, Amazon, and Meta have committed over $300 billion combined. That money flows directly into these 10 companies. Now, a disclaimer. This isn't financial advice. These stocks are volatile and some trade at very high valuations. Always do your own research before investing. But long-term, the trend behind these numbers is hard to ignore. If this helped you understand the AI market better, subscribe for next week's breakdown. Tomorrow, we're covering something big. A major earnings report just dropped today, and it could change this entire list. Tap the video on screen to see what happened and what it means for your portfolio.